Okay, welcome back to Self-Managed 360. We will not now talk about dividends. Some investors are investing on the stock markets to get to receive payments in the form of dividends. So before I go into a little bit more detail on dividends, what you will find in terms of information when you browse on financial websites in order to have information on whether a company is paying good dividends or not, you will end up with some kind of the information that are provided here. So you will see first of all the stock prices. So for example, a company is currently selling at $40 a share. You may see also the earnings per share, or you will see the earnings per share. We've talked about this in the previous videos. It's the profit that is allocated for each share that is trading on the markets. And you will also have information on the level of dividends that are paid for each shares outstanding. So for example, in our case, again, it's a fictional company. For example, this company would be paying $1.50 per share outstanding back to its shareholders every year. That's always a yearly value. Value per year. So you want to know what's going to be your return on your investment if you only consider dividends. So that's going to be the dividend yield. So basically, it's how to calculate it. It's the dividend per share, which is $1.50 in our case, divided by how much you have to pay to own a share, $40, 3.7%. So that's a typical way to evaluate the performance of a stock on dividends only. You kind of consider your investment in the stock as if it was a bond. So how much? What's the coupon value, for example? In that case, for each share, the coupon value is $1.50, and you pay $40 to own $1.50 worth of dividend every year. Obviously, the difference with bonds is that while you own it, this will change. It may go down, it may go up, so you don't really know what's going to be the stock price when you decide to sell it back. Yeah, but you can calculate how much you expect per year in income. So obviously, 3.7 is not that much, but it's better than nothing. Dividends are sometimes controversial. You need to understand that dividends are considered as additional income to shareholders. So when you receive the payment of a dividend, you will need to pay tax on it. Dividends are cash payments that are leaving the company. So basically, when $1 is sent in the form of dividend to a shareholder, this dollar is leaving the balance sheet of a company. It's leaving the bank account for good. So the company is not in a position to use this money to finance its growth or its activity. So some shareholders or investors don't like this. Others prefer to have a dividend than to leave the money in the bank account of the company. So the question to ask yourself is, if a company has a spare money in its bank account, can you invest it better than the company to create value for yourself? That's a question to be asked. We will talk about, in the following video, we'll talk about return on equity. This is a measurement that can be used to verify if the management of a company is using the money that it's holding in a company to better use, or it should just return the money back to the investors or the shareholders. So every single company is different. Some companies have business models that require some cash to finance growth. So obviously, money leaving the company in the form of dividends will impact the growth strategy of a company. So basically, if you want to invest in stocks paying dividends, you need to understand that the money will be sent to you, so it's not going to be available anymore to the company to finance its growth. So it may have an impact on how the earnings per share can actually grow in time, and that will probably influence as well the rate at which the price of the stock can grow, which will impact your investment performance. However, receiving dividends can be useful. You can use it for better uses. You can, if you're entering retirement and you need extra income, investing in high yield dividends stocks can be interesting too. Remember that the money that is sent to shareholders from a company has already been taxed on the corporate level. So a company has already paid tax on its profit, and whatever is going to be left can be reused to finance the operation of the company, to fuel its growth, or it could be paid back to its shareholders in the form of dividends. Once the money is leaving the company, the burden of paying the tax will be on the shoulder of the shareholders, because dividends will be considered as extra income. So the shareholders will have to pay taxes on top of the taxes already paid by the corporate, by the company itself. So basically, if you can, try to invest in high-paying dividend stocks that are, if you can invest in a tax-free account. Some tax-free accounts exist in some jurisdictions. Sometimes retirement plans can provide this type of fiscal shield for a while. You may want to invest in high-paying dividend companies that, if you're entering retirement, because you need the extra revenues or you need income to finance your retirement. So that could be why you want to invest in high-paying dividend stocks. And what you want to make sure, if you decide to invest in a stock based on its dividends policy, you want to make sure that the dividends per share paid is lower than the EPS. Why? Imagine here, a company is making $3 of profit per share, but it would decide to jack up its dividends per share to $4.50. Well, if it would be $4.50, if you divide $4.50 by 40, you would end up with a nice 11.2% dividend yield, which is really nice. But most probably the dividend policy will be unsustainable, because the company would pay more in dividend than it's making profit. So you want to make sure that the company is retaining a good chunk of its profit into its bank account to finance its operations, finance its debt, to repay its debt, to fuel its growth, and then whatever will be sent to you will be a portion of the earnings per share. If you invest in stocks that are paying more dividends than they are generating profits, well, that can be risky. So you have to look at this aspect before jumping on an investment opportunity that provides a very high dividend yield.